Hey everyone, thanks again for making it back to my channel. For those who are new, this is the Finance Hub where I help you understand the exciting world of finance. Today we're diving into how to start investing in the S&P 500. Before we jump in, make sure to hit that like button, subscribe, and share this video. Let's break down what might be keeping you from the financial freedom you deserve. So, what exactly is the S&P 500? Imagine a giant basket filled with 500 of the largest, most successful companies in America. You've got Apple, Amazon, Microsoft, Google, all the big players. That, my friends, is the S&P 500 in a nutshell. These are publicly traded companies, meaning you and I can buy a piece of them. And these 500 companies represent about 80% of the entire US stock market. Think about it this way. If the US economy is doing well, chances are the S&P 500 is doing well too. It's like having a front row seat to the American dream. The S&P 500 has been around since 1957 and it's been steadily growing ever since. Sure, it has its ups and downs just like anything else in the market, but over the long term, it's consistently gone up. You don't have to be a Wall Street hotshot to get in on the action. Investing in the S&P 500 is actually much simpler than you might think. Now, you might be wondering, why should I care about the S&P 500? Well, let me tell you, this bad boy is a big deal in the financial world. It's like the Beyoncé of the stock market. Everyone knows it, everyone watches it. The S&P 500 is often used as a benchmark for the entire US economy. If investors are feeling confident about the economy, they'll pour money into the S&P 500 and it goes up. But if they're feeling nervous, they might pull their money out. And guess what? It goes down. So, by tracking the S&P 500, you're essentially keeping your finger on the pulse of the American economy. It's a pretty good indicator of how things are going overall. When you invest in the S&P 500, you're essentially buying a tiny piece of all those companies. That's right, you could own a sliver of Apple, a smidgen of Amazon, a pinch of Google, all with a single investment. It's like having a diversified portfolio on autopilot. Over the past 90 years, the S&P 500 has returned an average of around 10% per year. Now, I'm not saying this to guarantee future returns because past performance is never a guarantee of future success. But it does show the power of long-term investing in a diversified index like the S&P 500. Okay, so by now, you're probably thinking, this S&P 500 thing sounds pretty awesome. How do I get in on this? Well, hold your horses because I'm about to break it down for you step by step. First things first, you need to open a brokerage account. Think of it like a bank account. But instead of storing your cash, you're storing your investments. There are tons of brokerage accounts out there, like Fidelity, Schwab, Vanguard, you name it. Now here's the key, you don't want to buy individual stocks in all 500 companies in the S&P 500. That would be a logistical nightmare, and let's be honest, ain't nobody got time for that. Instead, you're going to invest in something called an ETF, or an index fund. These are like little baskets of investments that track the performance of a specific index. In this case, the S&P 500. So when you buy an S&P 500 ETF or index fund, you're essentially buying a tiny slice of all 500 companies in the index. It's like having a personal chef prepare a gourmet meal for you, instead of you having to source all the ingredients and cook it yourself. When it comes to choosing an ETF or index fund, there are a couple of things to consider. First, look at the expense ratio. This is basically the fee you pay to the fund manager for managing the fund. You want to keep this as low as possible because those fees can eat into your returns over time. Second, consider the trading volume. You want to choose a fund with a high trading volume because this means it's more liquid and you'll be able to buy and sell shares more easily. I'll do another video on ETFs only, to stay tuned. Now, let's talk about why investing in the S&P 500 is such a smart move. First off, diversification. Remember that basket of 500 companies? That's diversification at its finest. By investing in the S&P 500, you're not putting all your eggs in one basket. You're spreading your risk across a wide range of industries and companies. So even if one company or sector takes a hit, your entire portfolio won't crumble. It's like having a safety net for your investments. Second, historical performance. The S&P 500 has a pretty darn good track record. Over the long term, it's consistently trended upwards. Now, I'm not saying you're going to become a millionaire overnight by investing in the S&P 500, but if you're looking for a way to grow your wealth steadily over time, this is a pretty solid option. Third, it's easy to understand. The stock market can be confusing, but the S&P 500 is pretty straightforward. It's a simple way to invest in the overall US economy without having to be a financial expert. And finally, it's relatively low maintenance. Once you've invested in an S&P 500 ETF or index fund, you don't have to constantly monitor it or make trades. You can just sit back, relax, and let your money grow. It's one of the most reliable ways to build wealth over time. Now, before you go all in on the S&P 500, there are a few things to keep in mind. It's not a magic get-rich-quick scheme, and like any investment, there are risks involved. First and foremost, remember that the stock market is a volatile beast. It has its ups and downs, and the S&P 500 is no exception. There will be times when the market dips and your portfolio value might go down. But here's the thing. If you're investing for the long term, those short-term fluctuations shouldn't scare you. In fact, market dips can actually be a good opportunity to buy low. Second, consider your risk tolerance. If you're someone who panics at the first sign of a market downturn, investing in the stock market might not be the best fit for you. It's important to assess your risk tolerance and choose investments that align with your comfort level. If you're not sure where to start, talking to a financial advisor can be a good idea. Diversification is key. Remember, while the S&P 500 is a great foundation for any portfolio, it's also a good idea to diversify across other asset classes like bonds, real estate, or even cryptocurrency. And finally, make sure you have a solid financial plan in place. Before you start investing, it's crucial to have a budget, pay off high-interest debt, and build up an emergency fund. Now, the million-dollar question, how much should you actually invest in the S&P 500? Well, my friend, there's no one-size-fits-all answer. It depends on a few factors, like your financial goals, risk tolerance, and time horizon. First, think about your financial goals. Are you saving for retirement, a down payment on a house, or maybe a luxurious vacation? The amount you invest will depend on what you're saving for and how much time you have to reach your goal. Second, consider your risk tolerance. If you're comfortable with a little more risk, you might allocate a larger portion of your portfolio to the S&P 500. But if you're more risk averse, you might want to start small and gradually increase your investment over time. Third, think about your time horizon. The longer you have to invest, the more risk you can afford to take. If you're young and just starting out, you have time on your side to ride out any market fluctuations. But if you're closer to retirement, you might want to be more conservative with your investments. Now, here's a general rule of thumb: aim to invest at least 15% of your pre-tax income for retirement. This might seem like a lot, but trust me, the earlier you start, the better. And remember, investing isn't just for the wealthy. You can start small, even with just a few dollars a week. The important thing is to start somewhere and make investing a habit. Now, I know what you're thinking. I don't have a ton of money to invest all at once. Well, my friend, I've got good news for you. You don't need a fat stack of cash to get started. In fact, there's a strategy called dollar cost averaging that's perfect for beginners. Here's how it works. Instead of investing a lump sum of money all at once, you invest a fixed amount at regular intervals, regardless of the market conditions. For example, let's say you want to invest $500 per month in the S&P 500. With dollar cost averaging, you would invest $500 on the same day each month, whether the market is up, down, or sideways. When the market is down, your money buys more shares. And when the market is up, your shares are worth more. Over time, this strategy can help you average out the cost of your investments and potentially reduce your risk. Plus, it takes the emotion out of investing, which is a good thing. Because let's face it, we humans tend to make irrational decisions when we're driven by fear or greed. Dollar cost averaging is a simple, effective way to invest in the S&P 500, even if you're starting with a small amount of money. And there you have it. Now you know what the S&P 500 is and how to get started investing in it. Thanks so much for watching. If you found this video helpful, please like, subscribe, and share it with anyone who's interested in learning about investing. And if you're ready to go further, check out our next video. I'll see you in the next one. Disclaimer: this is not financial advice. The stock market is a device for transferring money from the impatient to the patient. Warren Buffett.